Have you ever kind of looked at really wealthy people and wondered, how do they do it? How do they build these massive fortunes and somehow seem to pay way less in taxes? Well, today we're going to pull back the curtain on a powerful strategy they use. It's called buy, borrow, die. And trust me, once you get how it works, you'll never think about your money in the same way again. So let's start with a really basic question. Just think about it for a second. Why is it that the money you get from your job gets taxed, but other cash you might receive doesn't? The answer to that simple question is the key that unlocks this entire strategy.
And here's the answer, plain and simple. On one hand, you've got earned income, your paycheck. The government taxes that pretty heavily. But on the other hand, you have borrowed money, a loan, and that is tax-free. Why? Because technically it's not income, it's debt you have to repay. This one tiny distinction is the loophole the entire strategy is built on. So how do you actually use this principle to build wealth? Well, it's a three-step cycle, a method that completely flips the script on how you generate cash flow and grow your net worth year after year. Let's unlock it.
Okay, the name sounds a little intense, but the strategy itself is surprisingly simple. First, you buy assets that you expect to go up in value. Think stocks, real estate, that kind of thing. Second, and this is key, instead of selling them, you borrow against that new, higher value. That loan gives you tax-free cash to live on. And third, the die part, sounds morbid, I know, but this is where a wild feature of the tax code kicks in for your kids. And that tax bill from all that growth, it can literally disappear.
All right, let's break this down, starting with the most important part of the whole cycle. Step one, you gotta buy. And this isn't just about owning stuff, it's about buying the right kind of assets that become the engine for everything else.
And that brings us to a super important concept, unrealized gains. So let's say you buy a stock for $1,000, and over time it grows to $10,000. That $9,000 in growth, that's an unrealized gain. As long as you don't hit the sell button, you haven't technically realized the profit, so the government can't tax it. It just sits there, growing. So what kind of assets are we talking about here? The classics, really. Real estate, stocks and index funds, some types of life insurance, even things like fine art. But here's the one thing they absolutely must have in common. They have to be lendable. A bank has to look at your asset and say, yep, that's good collateral. We'll give you a loan against that. I love this analogy because it captures the mindset perfectly. This isn't about day trading or flipping houses. It's about letting your assets just cook. You put them in the financial crockpot and you let them appreciate slowly and steadily for years. The whole point is to avoid interrupting that growth. Okay, so your assets are in the crockpot, they're cooking away, and their value is growing. Fantastic. But how do you pay your bills with that? That brings us to step two. You borrow. This is the genius part, where you turn that on-paper growth into real spendable cash without paying a dime in taxes. This is the golden rule. Seriously, this is the whole game. The second you sell that asset, you trigger a taxable event. The tax man comes knocking. But if you borrow against it, nothing. A loan is not income, so it's not a taxable event. End of story. Just look at the difference this makes. Let's say you need $100,000. If you sell off part of your portfolio to get it, capital gains taxes could easily eat up 20 or 30%. So you're left with, what, 70 or 80,000? But if you just borrow that same $100,000 against your portfolio, you get the full amount, all $100,000, tax-free. It's a huge difference. Now, you're probably thinking, okay, but a loan isn't free, you have to pay interest. And you're absolutely right. But let's just compare the costs here. Selling means you might pay a 30% tax rate. Borrowing means you might pay a, 5, 6, 7% interest rate on the loan. The math is pretty clear. Paying a little in interest is almost always way, way better than paying a ton in taxes. But what about all that debt, right? This leads us to the final and honestly the most unbelievable part of this entire strategy. Step 3 is where all those loans you took out and that lifetime of gains on your assets, well, this is where they meet their final reset. The magic trick here is a little-known tax rule called the step-up in basis. So here's how it works. When you pass away and you leave your assets to your heirs, the IRS basically forgets what you originally paid for them. The asset's cost basis gets stepped up to whatever it was worth on the day you died. And just like that, the entire taxable gain that built up over your whole life is just erased. So let's walk through a quick example. Imagine your parents bought a house for $500,000 way back when.
And over their lifetime, it grows and grows, and it's now worth $2 million. That means there's $1.5 million of growth, of unrealized gain, just sitting in that property.
$1.5 million. That is a massive, massive gain. If they were to sell that property, they would be hit with an absolutely enormous tax bill.
But because of the step up in basis, when their heirs inherit that property, that entire $1.5 million in growth is never taxed. Poof, it just vanishes. The tax slate is wiped completely clean, and that lifetime of appreciation becomes a tax-free gift. It's incredible. So when you put all these pieces together, the buy, the borrow, and the die, it really does force you to redefine what income even means. It requires a complete and total shift in your financial mindset. See, most of us are taught the old way. Work hard, climb the ladder, earn a bigger paycheck. But the wealthy way is totally different. The focus isn't on earning more income from your job, it's on accumulating more assets. Because your assets determine how much you can borrow, and that borrowing capacity becomes your real tax-free income. And this really gets to the heart of it. The true engine of building wealth isn't your salary. It's uninterrupted compounding. It's letting your assets grow and grow and grow for decades without ever hitting the brakes by selling and paying taxes. This quote from the source material just says it all perfectly. Your income becomes a reflection of your assets, not your labor. When you're using this strategy, the cash you have to spend is no longer about the hours you put in at work. It's a direct reflection of the value of the things you own. Now, I know what you might be thinking. This sounds like something only billionaires can do. But the principles, they can start small. A modest stock portfolio can grow. A single rental property can become a borrowing machine. What really matters isn't how much you start with, it's the discipline to stick with the plan. Don't sell. Don't interrupt that beautiful compounding. Just let your assets do the work. So, as we wrap this up, the big question to ask yourself is this. Now that you know how this works, what's the one asset, just one, that you can start focusing on growing starting today